The second quarter Experian Consumer Default Index suggests that South African consumers are getting a better handle on their credit finance arrangements, with fewer people defaulting. But according to Jaco van Jaarsveld, head of commercial strategy and innovation at Experian, it's also had something to do with financial services providers' risk appetite levels.
Over the last 2 years, financial services providers, banks, retailers, lenders have stopped lending at the rate. So they've applied far more conservative lending practices, which is now resulting in improved performance because there's fewer people to default due to the fact that they lend less.
Having endured a higher interest rate for longer environment, some consumers have battled to honour their debt agreements, while also trying to grapple with the higher cost of living. Van Jaarsveld says home loans, which account for about 1.2 trillion rand of the total 2.7 trillion rand debt market, have been the most difficult loans to service with the increase in interest rates. But with the interest rate cutting cycle seemingly having started, there's hope.
Now, with the rate decreases starting, as I mentioned, the biggest benefit will be felt in the secured lending space, and that's where the majority of outstanding debt in South Africa lies. And as interest rates reduce, we expect the CDI also to markedly increase as we go into the next few quarters.
On a more positive note, the Consumer Default Index noted that women had made some strides in being able to get secured loans, like home loans and vehicle loans, where historically that had been less of the case.
We've seen an improvement over the last 4 years where women get more access to secured lending and access to home loans in particular, but still far off being equal to access to home loans like men do. Whereas in the unsecured world, women have far more growth and equality in the unsecured lending world for personal loans, credit cards, retail loans.
Experian says typically the South African consumer springs into spending action in the third and fourth quarters, mainly due to the Black Friday month of November and the festive season, and warns that the Consumer Default Index may only deteriorate again in the first quarter of next year, as consumers face the hangover of the spending spree from before. Nompumelelo Siziba, SABC News, Johannesburg.